Welcome one and all to the 2026 Keystone Forecast event.
Absolutely. Welcome to all of our Facebook viewers as well.
So,
Give people a couple minutes to get signed in here, but glad you're here. We'll let people pop in. We actually have quite a few RSVPs today, although we know a lot of people end up watching this as a replay, right? Because then you can speed us up, right? If we're getting a little long-winded.
absolutely. And we got some good stuff to go over with today.
Yeah, we sure do. No shortage of things to talk about when it comes to the market and the economy.
Absolutely. And as always, we have that Q&A feature. So if you do have questions, please throw them in there. We'll try to keep an eye on it throughout the podcast, throughout the recording. But
some of you will be listening to this on a podcast.
Fortunately, podcasts don't really have Q&A features.
That's true. That is a big advantage for those of you who are on here live right now. Use that feature. It's certainly fun for us to be able to answer some of those questions. But yeah, if you think of any afterwards too, we certainly would love to answer that by email. You can just email either one of us. We've got that at the end. Of course, you can just call us as well. I think that's fun.
Absolutely.
Yep, good deal. All right, well, let's get started. We are going to call our forecast 2026 Riding the Wave this year. Because I mean, it certainly is. Sometimes waves can be smooth and sometimes not. I think that's what
Absolutely.
we've seen this last year. Doesn't mean the end of the story is bad necessarily, but yeah, a lot of volatility this past year. I don't know that that will change this year. But
Probably a lot more of the same.
yeah, certainly. Yeah, there's a lot of good things to report as far as economic news and returns and so forth, where we think things are going. So that's really when we do the forecast, and our halftime presentation comes halfway through the year. It's about talking about kind of what we're seeing based off of all the experts. And of course, the experts oftentimes are wrong, right? They don't know exactly what's going to happen, but they're all paid to give an opinion, and so we're going to give ours.
That is right. That's what we're here for. And so this is us. There we go. Should be able to go now.
All right.
By all means, so Josh Nelson, Jeremy Bush. We will be doing our best to be giving you all of this information, right? But as the compliance always says, is these are our opinions.
Yeah,
Right?
absolutely. You'll notice at the end, after our names, it says CFP, Certified Financial Planner. And that's the gold standard in the financial planning industry, as you want that CFP. Not that it guarantees anything necessarily, but it does say that they're a fiduciary, number one, right? So if you hold yourself out as a CFP, you are a fiduciary, which is a legal standard that we have to look out for your best interests. That's a very different standard than maybe somebody who's a broker or a salesperson. They're not obligated to do that. So not to say that they're bad people, but there is a difference between working with a fiduciary or not. So certified financial planner, that's both of us. We actually have 4 advisors now on our team, but Jeremy and I are the senior advisors. Doesn't mean we're old, but it does mean that we've been here and have more experience. Let's just say that.
Been around the block a couple times, I'd say.
Exactly. So, yep. When we talk about the disclosures, these are the things that the attorneys wrote. So basically, it just says it's our opinions, right? Everything that we talk about is our opinion. Nothing is guaranteed. As always, past performance is not indicative of future results.
Well done. Absolutely. So we both like this visual here. So when a lot of the time when we're doing planning, we talk about it as a linear progression, right? And as far as time goes, yeah, that's kind of the pace. But in reality, it's financial planning. It's not a single plan, right? Things come up and we have to alter the plan or pivot here or there. And that is what we're here for.
Yep. And like any kind of a plan, obviously that plan is not worthless necessarily once the battle or the boxing match or whatever metaphor you want to use. It's not to say that, planning and coming up with a plan is indispensable, but then you have to adapt, right? And certainly that's what we think is fun, right? As planners, we're working in an environment of uncertainty. And so for those of you who are looking at the slide, your plan versus reality, I mean, that's life, right? The market, the economy, our personal lives, our professional lives, there's going to be a lot of great things that happen. And then there's going to be unexpected stuff, things that we weren't, some surprises we didn't want. Sometimes that happens. So we do need to react to that. And of course, be proactive, be thoughtful, right? Thinking in advance, but also when we're doing planning, it's really the decisions that are made, especially during those difficult times, as we'll talk about here in a bit, some of the data, some of those decisions. And sometimes that decision is to do nothing, actually, to not act rashly, just like being on an airplane when things get really turbulent. Probably not a good idea to take off your seatbelt and jump out the door, right? That's
Absolutely.
probably not going to work out for you. So certainly this last year would be a good example of one where there were lots of twists and turns, but the story ended up being fine.
Yeah, absolutely. And speaking of all these things that kind of randomly happen out there. So this is a nice chart. This goes all the way back to 1900. It just kind of picks out some of, the biggest things historically that happened.
Yeah.
And, not to discount any of these things, like there's a lot of really rough things that happened throughout this time. And at the time, the thing to remember is that at the time, all of these felt like the end, right? Or pretty close to it. Pretty dramatic events. But the line is basically showing us the Dow Jones over this time frame and what it did.
Yeah, absolutely. And some of the extremes along the way, the Great Financial Crisis, the Great Recession back in 2008, 2009, that was one, at least in my career, that was the largest drop we had ever seen in the market, which on a large scale like this, it looks like, well, like that wasn't that big of a deal, but it sure was at the time. And for those of you who have seen the movie The Big Short or read the book, it's a great description actually of what happened at the time and why there was so much risk and why the market reacted so violently at the time. But it's kind of interesting when you look on a large scale like this. You look at kind of extreme, well, at least what we thought at the time, like the pandemic. That certainly it affected the economy in a big way. A lot of people's jobs were affected. Certainly not to make light of it, but that's on a large scale. It wasn't that big of a drop, right? Things actually did end up bouncing back.
Yeah, absolutely. So overall, kind of where are we looking? And we'll get into more details on this, of course. But 2026 actually looks to be like a pretty decent year overall. We'll kind of get into the whys of it. Wave of deficit finance stimulus, lower rates. AI is definitely a big part of this.
Yeah, continues to be for sure.
But of course, there's always uncertainty, right? There's still a lot of uncertainty around inflation, various other things happening in the world and in the US. So that's not going away anytime soon either.
Yeah, and some of those, I mean, it could be clouds that, they kind of look a little bit dark and maybe they're things that we suspect could happen. And sometimes they do, right? Sometimes weather forecasts do end up being accurate, right? And you end up seeing, right, you end up seeing a tornado form. But most of the time that doesn't actually happen. So yeah, this year we're expecting 12 to 15%. Again, based off of what we see and based off of all the experts, we're expecting a 12 to 15% increase in stocks as a broad category, right? There's lots of different types of stocks, right? So this assumes a very broadly diversified stock market, not indicative of one sector. So a little bit less than last year. Last year, I think we ended up about 15, 16% in the overall stock market, which was certainly above averages. We think we're still going to be above average this year. Not quite as much. And then the bond market, probably a bit more muted, probably just looking at yields this year that you'll be getting off of fixed income bond type investments in the 3 to 5% range. So in other words, we're not expecting any huge appreciation in bond prices like we saw last year. Many of our clients, their bond fund holdings in their portfolio actually increased in the 6 to 8% range last year. So fixed income typically doesn't do that. You don't typically see appreciation in your fixed income. In some years, like 2022, we saw a big drop in fixed income prices because there's a seesaw effect. When interest rates go up, it makes bond prices go down. As we get into fixed income here in a bit, we're going to unpack both of these categories, both stocks and bonds, right? And as far as the why, why are we seeing this in the forecast?
Absolutely. Yep. And so really then it comes down to, economy and policy, right? So what is happening kind of in the world and what are we looking at? So we'll start out with the labor market. On the positive side, job growth has slowed but has not stalled, right?
Yeah.
Unemployment has edged higher, yet we're still pretty historically low,
We have been.
when it all looks at it. So a number of charts on here just basically kind of telling the same story, right?
Yeah. Yeah. I remember back when I started as an advisor back in '99. Back then, the experts said that if we were under 5% unemployment rate, that was considered full employment. In other words, yeah, obviously there's always some job transitions and things like that, but more or less what that means is that anybody who wanted a job had a job, may not be the job they wanted, right, or the pay that they wanted, but they had the opportunity to get a job based off of the available job market that was out there. And we've been consistently under that number basically since the pandemic. It
Mhm.
spiked way up there, right? We saw this huge spike, which we'll hit in just a second. But yeah, other than that, I mean, really the unemployment rate has stayed low for quite some time. That's not to make light, by the way, of anybody's situation because we have clients that
Oh,
certainly
absolutely.
experience layoffs, or maybe they've got kids and the kids can't get a job, those sorts of things. So there's always going to be some of that. But as far as historical trends, that's what we're seeing.
And one factor on that one too is it says that prime age employment.
Mhm.
So pretty much prime age
Jeremy and I
employment,
are still in prime age, by the
prime
way.
age, absolutely. So really what they say is prime age employment is people who are retiring in that kind of 65 to 67
Mhm.
category, right?
Yeah,
So people waiting for Medicare to kick in, Social Security. Basically, it's an indicator of income stability,
yeah.
if you will. And so had an uptick in that, remains at a pretty constant high, that most people who are retiring are in that income stability range.
Yeah, yeah, exactly. And in a lot of cases, people do retire in their mid 50s to mid 60s. Sometimes we see kind of outside of that, but yeah, that primary kind of working population at 25 to 54. Again, we're both in that right now. So earners, but yeah, once you hit that retirement age, a lot of spending ends up happening as well,
Absolutely.
which certainly is a driver of the economy.
Absolutely. And so some of you may remember a company that we were with, our friends over at Carson.
Yeah,
They put
they are
together
still our
this,
friends.
yep, this nifty little chart here. It's basically, the trends of the economy and index of what's expected,
Mhm.
right? And really, this is kind of basically telling us that, there's some definite upsides in current economy and market.
Mhm. Yeah, absolutely. And you see a couple of big negatives if you're looking at the chart, a couple of big negatives back in the financial crisis. In other words, you're looking at a lot of different factors that go into that index. But during the great financial crisis or Great Recession, again, that would have been 2008, 2009, or certainly the pandemic, a sharp
Mhm.
decrease when you're looking at shutting the entire economy down, right, which had never been done before, at least in our lifetimes, had never
Yeah.
been done before. So it certainly had a huge impact. But what's interesting, though, on the scale is that there was a huge bounce back too. We saw unemployment rates go down into the 11, 12%, I think, at the time, which was historically very high. And then we saw this big bounce back, right, where jobs came back so quickly that in a lot of cases, that was actually the biggest challenge for businesses in 2021, 2022, is that they couldn't get people, right? People
Mhm.
had left jobs maybe that say if you had a job you didn't like, maybe it was a hard job, something like that, and you found something that was better. Maybe people found the opportunity when the economy came back to bounce into
Mhm.
a better job opportunity.
Absolutely. But
So yeah.
yeah, really just kind of go into it, really what this is telling us is there's not a lot of indicators signaling, any kind of
Mhm.
deterioration
Yeah.
or recession type
Yeah.
things on the pipe.
Absolutely. Yeah. And it's some of the thing like a recession like the pandemic, how do you predict that?
Right.
Right.
There's
So
always going to be something.
yeah, there are, certainly recessions that we've had in the past, though, that there were clear signs that the economy was slowing, things were deteriorating, and that's just not what we're seeing right now, at least.
Absolutely. So another one point of brightness on the horizon really is actually internationals.
Mhm.
So I would say over the last probably couple years, honestly, internationals have not been a big bright spot,
Mhm.
right, within portfolios. But we always want to make sure that there is some international in there,
Yeah.
right, and that we're taking advantage of it because it does serve a purpose in diversification.
Yeah, absolutely. And in both cases, both developed international, which broadly you would look at that like Canada, Western Europe, Japan, Australia, those would all be examples. South Korea, those would be all examples of developed international versus emerging would tend to be Southeast Asia, Africa, Latin America, Eastern Europe. So it's important to have both, certainly, but there's different risk factors and there's different diversification benefits.
Yeah, absolutely. And so obviously this is probably no big surprise to anybody, but looking at spending in tech, mainly around AI
Yeah.
related stuff, right? And so we look at kind of five of the biggest companies involved in this.
Do.
As it so happens, we actually have clients from four of these five,
We do.
which is kind of fun. But really what we're looking at here is just kind of off the charts level spending. So it's at its highest level, a lot of infrastructure involved with AI, a lot of major players that are developing it
Mhm.
and bringing it along.
Yeah, these companies are spending from their profits here. And for those of you who don't see the screen, it's Microsoft, Alphabet, which is Google, Amazon, Meta, Oracle. We could add in others like Apple or Broadcom. Also,
Mhm.
companies that we have quite a few clients that work for those companies. That's always been kind of our niche, has been the tech sector. So these companies are all extremely profitable right now. So that's one important point to make, I think, is that versus the late 90s,
Yeah.
right, where the dot-coms, right, there was a dot-com bubble that hit. A lot of those companies were not profitable, and many were never profitable.
Mhm.
Actually, there are probably some examples of smaller AI related companies right now, I'm sure, startups, things like that, that are not profitable. But the big ones, the big companies, yes, they're investing a lot of money right now, but it's coming from earnings. It's not fictitious money or all being borrowed necessarily. They are making a lot of money, so that's where
Absolutely.
that's coming from.
Yeah, absolutely. Yeah. And this one kind of shows it, right? So booms and busts, right? So on that first one is kind of the dot coms, right?
Yeah.
So we had big booms, busts. And I have heard this from clients, from other individuals as well, is like, well, this feels a lot like,
We
right,
hear that a
the
lot.
dot
Yeah,
coms,
yeah.
right? But I think you nailed it on the head, is that there are some pretty big differences in that as well. Yeah, there are similarities, so it does definitely feel that way.
Mhm.
I can understand that. But the fact of the matter is yeah, these, like you said, these companies are established companies. This investment is coming from margin profits,
Mhm.
right? So it's not just anybody with a computer making a dot com and throwing it out there, getting people to throw money in it with nothing behind it.
Right. Yep. And that I remember that happened. Again, I started
Mhm.
as an advisor in 1999, so that was still happening at that point, for sure. And it was very ugly, right, when the bubble burst. And so I think there's some rational fear out there if you've been through some of these in the past. And the three that we're showing you, excuse me, the three we're showing here is the dot-com bubble or Y2K, which is kind of funny now, actually to look back. But yeah, I remember. I mean, there was all this fear, and for those of you who are younger too, the crux of it was that when computers were technology, computers and everything, it was all programmed for two-digit years, right? So
Mhm.
if it was 1987, you would just have 87. You wouldn't have 1987. And so, well, gosh, what happens when the calendar flips, right? And we get to 2000. Now, what's going to happen? There's all these
Right.
crazy predictions that all the nuclear bombs are going to go off, at midnight or, something like that, right? Again, laughable now. Excuse me, I've got a cold, so if
Yeah.
I'll let Jeremy talk more than I will, but
We
yeah,
actually got a
that was
good
a big
question
fear.
here.
Yeah.
Yeah. We actually got a good question here. So, with gold cresting $5,000 an ounce, are you considering increasing exposure to gold in your clients' portfolios?
Yeah, and in some portfolios, if you've kind of watched activity we actually have over the last year,
Hmm.
in the form of ETFs, by the way, an exchange traded fund, those are liquid ways, instead of you having to go get a wheelbarrow full of gold, right? There are ways that you can get exposure to lots of different areas of the market, including alternative investments,
Absolutely.
which gold would be one of those. Not a bad part of a diversified portfolio. Just want to do it in a measured way. We'll kind of talk about that later.
Yeah.
Is that, yeah, should you have some exposure to AI stocks? Yeah, you probably should, right? And you do. If you're invested with us, you probably do have that exposure in your portfolio.
Mhm.
But don't put it all there, right? I think that's where people get in trouble and did in the
Yeah.
late 90s was that, hey, instead of having this be a diversified portion, let's put it all in tech stocks. Let's put it all in dot coms. Let's put it all in Cisco stock. Actually, Cisco stock over the last few months finally regained its high point that it hit back in early 2000. So that's kind of the poster child for a company that actually didn't go bust or they didn't go bankrupt.
Mhm.
but it was so overvalued that it actually took 20 plus years until it would have regained its value. So a diversified portfolio is going to have exposure to lots of different types of asset classes, which some people might find a little bit more boring, right? Versus making big bets on things. But that's a lot better odds of doing well over time
Yeah.
is having a portfolio that has lots of different ingredients.
Absolutely. Yeah. And so, kind of seeing that as being a good diversifier, I would say it's actually probably about 2 years ago that we really started aggressively adding gold in there. As far as additional allocation, trying to stick with the buy low, sell high thing. Yeah, I don't know if we're going to overexpose in any one area, but
Right.
it is definitely a included diversifier inside of portfolios.
Yeah, that's always tempting too. Right here, where you're showing the example of the .coms, the financial bubble that got formed from real estate, and then the energy was a little bit smaller bubble. But yeah, is there a bubble being formed right now? Yeah, I mean there are probably certain companies that are overvalued, right? So we want to be very careful about risk, right, and making sure that we're not taking too much risk in any one area. That's particularly important if you work for one of these companies, which again
Mhm.
many of our clients do. Is that we recommend even if it's a great company, right? No judgment on that, but it's so easy to get overexposed if you're getting restricted stock or stock options or something like that as part of your compensation. Very easy to get overexposed to that company or that sector just by your own benefits.
Absolutely. Yep. So of course, fiscal policy,
Mm.
right? We've been talking about this one for years and
Yeah,
things, right? Is that we know that US debt is at highest levels ever,
yeah,
right? And
38 trillion and counting. I think for
yeah,
the debt. Yeah,
and of course a balanced budget would be nice to see
it hasn't
coming out
happened
of
for a while. No, I think
yeah,
I
yeah.
think that since the 90s, something
It's
like that. Yeah,
I think the
yeah,
Clinton administration was the last one to
right.
actually have a balanced budget.
Yeah.
But of course, that always plays into it, right? So we always have to have that conversation about debt. How is that being managed and what, if anything, is being done about it?
Yeah, in the short term, borrowing money, just like if you did personally, right? If you went out and borrowed a bunch of money right now to buy a bunch of, think of something simple like you went out and bought a bunch of rental houses. It would be very easy though if things went backwards, maybe the economy took a slide, unemployment rates are up, and all of a sudden now your renters have bailed on you, right? Or you're having
Yeah,
to have big concessions now, 3 months of rent, things like that. All of a sudden you could be getting crushed, and if you had levered yourself up right, and had a lot of debt against those properties, you could actually find yourself upside down very quickly.
yeah,
So that's I think the concern long term is that, if our debt levels get unsustainable, if we continue to run deficits, how long can that go? So short term, it actually can be really good because, from a rate of return standpoint, it allows the economy to actually grow faster. But again, just like if you're an individual, you can only do that for so long, right? Or so much, right? Compared to what your economy is growing at.
yeah, absolutely. And of course, if you were watching this one this time last year, the
Yeah.
big word was tariffs,
Yes.
right? Everything happening, but really, as we saw it play out, is yeah, things spiked up quite a bit, and then everything kind of quickly backed off,
Mhm.
right? Largely policy, et cetera, but really overall, the actual tariffs that we're thinking about, if we exclude the kind of presidential tariffs,
Mhm.
right, that were put in their emergency act, not a lot higher than
Closer, yeah, closer to
historical.
historical averages, right?
Yeah,
Yeah, what you'll see on the slide too is 24 versus 25, obviously a huge increase, a five-fold increase in the effective tariff rate. But if you look at the IEEPA, which is the justification at least, and this is being wrestled with right now in the courts, right? As far
mhm,
as how much power does the president really have to impose tariff or tariff-like uh, restrictions, right, on different countries. So again, it's going to be very interesting this year to see how that plays out. But just taking those out, right, that presidential authority without Congress, in other words, that does get us to much lower numbers. So surprisingly, I think a lot of people thought that we were going to see a massive increase in inflation. Didn't materialize, or that it was going to have a huge devastating impact on the economy. Hasn't materialized. I think it mainly is just because companies, when you think about this, right, individuals and companies, whenever something happens, even if it's something bad, people adjust, right? And they figure it
mhm,
out pretty quickly. And that's, I think, what we've seen globally, right, is different countries and certainly individual companies And for those of you who are in supply chain, right, and anything, a lot of your jobs got impacted certainly because you had to adapt very quickly to trade. All the companies we mentioned before are global, right?
Yeah.
There's very few companies of any size anymore that are just strictly in one country, just
And
in
I
the
and
U.S.
I think that we've seen that time and again, over the years, we've been doing this long enough, we've been doing this together long enough
Yes.
that we've seen that, corporate America is just really good at navigating these
They
things.
have to be.
They
Yeah.
just,
Yeah.
they want to know which direction to go
Mm.
and they can make that work.
Yeah.
It's where they kind of freak out and things get really volatile is when a lot of stuff gets thrown at them all of a sudden and
Mhm.
they're like, we don't know which way to pivot.
Yeah, but if,
Right?
if you're the CEO of Walmart or Coca-Cola or Broadcom, any of these companies, you get paid a lot of money, right?
Yes.
Get paid a lot of money. They've got a board of directors. Obviously, it's not just one person, but get paid a lot of money to make those decisions. And kind of back to our first slide, right? That hey, here's the plan, and then here's life, right? Here's what
Yeah.
actually happens. They are paid a lot of money to navigate in a environment of uncertainty, and certainly as financial advisors, as your certified financial planners, that's our job, right? Is to
Mhm.
navigate your financial life, through the midst of all that as well.
Absolutely. And then, of course, Fed policy. Oh, thing doesn't want to play nice today.
Doesn't.
So really, I think, current policy rate is about 3.88%. I don't really think this changes a whole lot. Obviously, the Fed is keeping an eye on things. No real big changes. They're still expecting a couple cuts, I
A
believe, this
couple
year.
quarter point. Yeah.
But really, if we're trying to keep on this, what we see, later this decade
Mhm.
is probably some rate increases in a
Yeah.
measured way.
Yeah, not exactly measured, I think is the key, is
Mhm.
that we're probably going to see a couple more rate cuts. And who knows, right? I mean, it's going to depend on who the next Federal Reserve Chairman is. If there's political pressure, things like that, we might see rates
Absolutely.
drop, or if the economy were to deteriorate in a big way, kind of like back in the pandemic, right? That was
Yeah.
one of the first things that happened is both, the Federal Reserve lowered rates to zero. And for a lot of you, they have 2.25%, 2.5% mortgages. That's why rates went so low
Right.
there for a period of time. So probably not a lot of policy support, right? Some decreases, but historically we're not at a bad place right now, especially when you've got an economy growing in the 3 to 5% range, depending on whose numbers you're
Hmm.
looking at. It's probably about where we should be, maybe a little bit lower. And then some concerns about inflation, especially if that starts ticking up again above historical averages, then the Fed will feel pressure that they need to start raising rates.
Absolutely. So let's talk about equities or stocks, really. So,
It's just a fancy word for stock.
right,
Yeah.
just a fancy word for stocks. So really what we're seeing, so these are non-recession return distributions. So obviously recessions have, negative impacts on things, but overall kind of expected returns where things are at. But kind of the biggest thing is about 68% of the years that the S&P had an annual return over 10%. So 42% of the time
Mhm.
it's over a 10% return.
Yeah, but there were a lot of things that happened during that time too, from 1950 to the present.
Yeah.
So yeah, it's not to say that there were a lot of bad things that happened, right? A lot of recessions, hyperinflation back in the 70s, lots of things that kind of averaged into those years. So yeah, I think the main thing is it's kind of like flying, right? If you get on an airplane, you're going to experience turbulence. So it's actually fairly routine. As we go through here, it's pretty unlikely. I think that we're going to see a period that you see this massive drawdown,
Mhm.
right, during a non-recessionary time, which again, that's what we're expecting, is that we're not going to receive a recession this year.
Absolutely. Yep. And really the key to that is earnings expectations. So really, if we've said this before, right, the thing that ultimately drives the market is, people like you and me just spending money,
Right.
and that's not really slowing down. And so really how that translates is, what are the earnings per share of, say, something like the S&P 500,
Mhm.
and where they're expected. And so we're at a pretty good spot right now, but it does look like there is more room to grow on that.
Yeah, yeah, for sure. And so earnings have been very good. Sometimes people are, gosh, is there a bubble forming in the overall market, or that, gosh, can the market continue to go up? Well, last year it mostly was driven by earnings. Actually, earnings growth by and large was very good, not just in AI stocks. Again, I think it's a mistake to say what all came from that one sector. It's pretty broad based, actually. If you look at the S&P 500 and all the sectors, earnings have by and large been very good, and expected to continue to go up in the future. So, and that's really what a company is worth, is just its earnings. There's something
Absolutely.
behind it. In other words, for a company that doesn't have earnings, that's suspicious, right? And it could be a startup situation, but that's why those are very risky, and most startups don't make it. Most companies that are starting out don't make it because they can't get over that hump of profitability,
Yep.
right? So more mature companies, though, certainly, it all comes down to earnings. That's why quarterly earnings reports, why that's such a big deal, because a company is just worth its earnings, not the buildings and the inventory, things like that. That's a very minor part of a company's actual worth. Most of it is based off of its profitability.
Yeah, absolutely. And kind of more to that point is the fact of their corporate margins. So how profitable are they off of those
Mhm.
earnings,
Yeah,
right? Are pretty darn high.
yeah,
So scale, pricing power, productivity gains, all that stuff adds into it and makes them kind of more efficient, gives them bigger margins for that. Now we do have a good question here. Um, any read on what trends are driving insurance rates so high? I know we've been hearing that one.
yeah. In fact, we did a podcast on this a while back. Yeah, largely it's because of big events, and in other words, natural disasters, things like that. It's largely
Mhm.
because of claims history, and you look at certain areas like Florida, North California, that have had extreme weather events, and maybe there is a trend, right? And we're not going to get into the why as far as, gosh, was it global warming or whatever. It doesn't really matter for our purposes. I mean, we're just seeing insurance premiums go way up, but it's not because the insurance companies just want to make a whole lot more money. Actually, their margins haven't expanded a whole lot. It is just reacting to actual claims, right? And just the odds, perhaps, right? Maybe not. Maybe things will settle down, but the odds that some of these extreme weather events and large claims end up continue to going up. I think of the wildfires a year ago, right? In LA. Yeah,
Absolutely.
yeah, and somewhat predictable, right? It's not the first time that it happened, right? You've got dry area and the Santa Ana winds and so forth. But kind of wrestling with if they continue to sell policies at all, and that's a problem too, actually. If you
Yeah,
if
there are
you
some places that
you can't
will
even get insurance, right?
sell
Yeah,
policies like that anymore because, yeah, because they know they have to pay it out. And when you're working with, national insurance firms, yeah, it's, even though you're living in Colorado, because something happened in LA or because
yeah.
something happened in Florida, it is still going to affect your
Yeah, they kind of
overall
have to make up
costs,
for that, right?
right?
If they lost a bunch of money on claims elsewhere. So it's not to defend the insurance companies at all, right? Because they actually have to report to all the insurance commissioners. Insurance actually is largely a state regulated industry, and so when they're selling policies in a given state, they have to report to the insurance commissioner in that state. So there is some level of accountability. But yeah, we haven't seen that there's been this massive expansion in earnings of insurance companies. It largely is because of actual claims
Yeah.
and fear, I think, of, again, large claims in the
Yeah.
future, trying to
Future
react to
claims.
that. Yeah,
Yeah.
yeah, good question, though.
All right.
So yeah, profitability though, profit margins are higher across the S&P 500. So again, it should be some comfort back to earnings again. That's kind of a broken record what we're talking about here,
Mhm.
but that earnings are very strong, which give you a lot more justification for why the market is where it is right now.
Absolutely. And so just ending 2025, we just ended the third year of a bull market
We did.
in there. And, I think one thing that always comes up is, how long can this bull run?
Right.
Right. But on average, really what we're seeing is about, an average bull market, if we look over the history of this stuff, is about 67 months.
Yeah.
It's a pretty long time
Yeah.
frame.
About 5.5 years or so.
Yep.
Yeah. Yeah, and that's why we make money historically, right? We can't guarantee anything, right, for the future, but that's why you make money in stocks is that expansions, bull markets tend to last a lot longer than bear markets. But you have to suffer through those bear markets as they go.
Yeah,
So
absolutely.
this one started October of 22 was
Correct.
the actual start of the
Yep.
bull market, which means it was preceded by a bear market.
Right.
2022 was a bad year. I mean, if you were invested in stocks, bonds, pretty much anything that year actually
Yeah.
went down in price. Cryptocurrency went through the floor. I mean, that lots of different sectors got crushed. So even a diversified investor, you're probably down 20%
Mhm.
safely or somewhere close to it back in 22. And a lot of people forget about it. You know, we show charts like this and say, oh, that's right, there was a bear market.
Right.
It was largely because of aggressive interest rate increases because we had hyperinflation at the time. Just some crazy swings kind of coming out of the pandemic, some crazy swings that we saw in there. So, yeah, that's kind of the last one. There will be a future one, just to be clear, right? There will be
Right.
a future bear market, but this one is not any longer. In fact, it's a lot less than the average length of a bull market.
Yeah, absolutely. And so yeah, age alone isn't really a consideration on that stuff, right? But 3 years in and we're still pretty young. So kind of going into this, you can see various years here of how much even just the S&P has changed
Mhm.
over those bull market times,
Yeah,
right?
yeah, and you'll notice too that October historically is a bad month. Which, again, a lot of these, you see this big drop, a lot of bear markets end up hitting like the financial crisis. Actually, that was the worst month of the financial crisis. Stock market return would have been about October of 2008. So there is some effect, but a lot of times people want to like try to time the market off of that and say, well, then shouldn't we always be out in October? No, not necessarily. That would have been a bad
Kind of a
idea
tragedy.
this year, right? But it is kind of interesting. There
Yeah.
does seem to be at least some correlation to that.
Yeah, absolutely. And so really with year three behind us going into year four, what can you expect? Well, again, if we look at history here, your average is 13 to 14%,
Yeah,
which is kind of lining up with kind of what we were thinking at the beginning of this, right?
yeah, exactly. And we think more of an average year. Maybe expectations should be slightly lower than what we've seen the last 3 years,
Mhm.
but still likely to be a growth year.
Absolutely. But of course, there's always volatility,
Mhm.
right?
Yeah.
So I know we've brought up this indicator in the past. Um, but kind of there's always pullbacks basically in the market, right? So they're very normal. They don't feel very good
No.
when they happen. But really, and we'll get into this in the next slide, but how often these pullbacks go and to what extent, right?
Yeah, yeah. The last significant one that we saw, and again, it's easy to forget these things, but it was last April.
Hmm.
We saw a pullback in the market related to tariffs. It wasn't quite a bear market. That's why I didn't register on our slide before as far as bear
Yep.
markets, but it sure didn't feel good, right? It was abrupt. Just like if you're on a flight, right, nobody, it doesn't matter how often you fly, right? Nobody likes turbulence. It's just not something that you're going to enjoy, right? Some people are maybe more used to it and they don't panic, right? Just because they know it is part of the experience. But it's important. That's why we spend so much time talking about risk and when we design portfolios for clients. That's kind of the central feature is first, let's talk about what kind of risk tolerance there is. That's our jargon for how
Mhm.
tolerant are you of the air pockets, right? When you're on the airplane and things are kind of jerking around. It's better to talk about that before you get on the plane, right? And some people just don't get on the plane. And that's all right. For some people, they just decide, from a portfolio standpoint, they might keep all their money in cash and CDs. Might be all things that are guaranteed or virtually
Mhm.
guaranteed. But the price that you're going to pay for that, of course, is that it's going to take you a lot longer to get there. So it'd be kind of like going from LA to New York City. You can get there in a few hours, or you can get there in a few days.
Yeah,
It's
absolutely.
a choice, right? And there's a huge trade-off. For many people, they're okay paying the price of turbulence, right, to get there in a few hours, as opposed to if you got plenty of time, and if, like it's like John Madden back in the day, right?
Right. Hop on my bus.
Yeah, he had his bus, right, and he just would not fly. He just knew that about himself. That nope, like I don't care.
Yep.
I'll take my time getting to the next location. But for most of us, we don't have that luxury, right? Unless you start with an awful lot of money. Most people are going to have a big inflation problem throughout their retirement if they don't have some growth. They don't have some parts of their portfolio that can outpace inflation.
Yeah, absolutely. Yeah, so obviously the pain is inevitable, but it also doesn't mean let's panic,
Mhm.
right?
Yeah.
So for instance, if we're looking at the Dow, so a 3% dip in the Dow happens about 7 times a year. To put that into perspective, a 3% Dow dip in the Dow right now would be about 1,500 points.
Mhm.
Okay.
Seems like a lot. Yeah.
Seems like a lot.
Yeah.
Yeah, absolutely. A 5%, which is about a half a correction,
Mhm.
right? They call it a mild correction. That's about 2,500 points.
Yeah.
Okay. That happens about 3 times a year.
Yeah.
And then we've said this one in the past that a correction or 10% down in the market happens on average once a year.
Yeah.
Right. To put that into perspective, a 10% dip is around 5,000 point swing.
Yeah.
So,
Yeah. Let that sink in for a
yep.
second.
Put some
Right.
numbers behind that
Yeah.
feeling and say, yeah, if I saw a 1,500 point drop in the Dow, that might raise some concerns, right? But it happens about 7 times a year.
Yeah, and again, that kind of going back to we might kill this metaphor, right? But back to the being on an airplane. If you're a seasoned traveler, you probably have experienced lots of turbulence and sometimes even extreme turbulence. Again, nobody likes it, right? But there's a right and a wrong way to react to that, right when it happens. So,
Absolutely.
it's so easy to forget about the turbulence of the past. I mean, how many flights really? I mean, even if you've been on thousands of flights, how many flights can you point back to and say, "Oh, I remember," the turbulence of LA to Hawaii back
Right.
in 2004 or so, probably not. I mean, there might be a couple, right, that are
Got a
memorable.
story to remember.
Yeah, exactly. But I mean, most of these dips that we experience, again, we pull up slides and things like that, and people are like, "Oh, that's right, right." We
Right.
we kind of forgot about that the market went down during that time period, and really the ones that register probably are more just the extremes, right? Like in the pandemic, financial crisis, dot-com crash. Those are the ones that truly are memorable, right? But even
Absolutely.
after those extreme drops, though, there's never been a bear market that wasn't followed by a bull market,
Mhm.
which is and the flip is also true, right? There's never been a bull market that wasn't followed by a bear market.
Call it a cycle for a
It
reason.
is, yeah, but you saw that chart at the beginning that went back to 1900 and the S&P 500 to the present. There tends to be, there's a trend, right? I mean, from then
Absolutely.
until now that companies figure out different ways of doing things. They invent stuff and we buy it. I mean, more or less, right? And people have jobs and so they have the money to, so that's the economy. But it's tough to go through those time periods. Again, that's the price. The volatility really is the price of those higher returns.
That it is.
Just
And
like
of
if you're going to
course,
Hawaii, I mean, it's like the turbulence is the price you pay besides the dollar amount, right? I mean, the turbulence,
absolutely.
that's the price that you pay to get to Hawaii.
Yep. And then, of course, throwing this one in there. So we're in year 2 of a presidential cycle. Historically, second term presidential cycles, year 2 tends to be a pretty good year,
Yeah, on
right?
average.
On average.
We don't know for sure, but it does work in cycles as well. And again, that's no political commentary. By the way, you'll notice that we always play Switzerland when it comes to politics. And obviously, there's strong feelings on both sides and everything. We stay out of that. We're
Mhm.
more just at kind of what's the reality. And as an investor, in other words, what does a smart investor do as far as how they design their portfolio? What decisions do they make along the way? But that is a trend, though, actually,
Mhm.
that on average, this would not tend to be a bad year if you looked at historical averages.
Yeah, absolutely.
Yeah. So
Typically that
back
is
to
the
our
case.
back to our stock market prediction.
Yeah.
In other words, it's kind of why are we thinking the market's going to go up? And we can talk about this individually as well, but I think there's good reason to believe that it's going to be positive this year. Doesn't mean there won't be
Absolutely.
air pockets, though. Again, think we can't hit home on that enough, right? Is that we don't know how we're going to get there necessarily. There's going to be a lot of stuff that happens in between.
Absolutely. So really when we're talking about the market and everything, especially when your major indices are pretty high,
Mhm.
right? Historically. Um, Something that always comes up in conversation is valuations. Is this overvalued?
Mhm.
Is that undervalued? How are we picking what we're investing in, et cetera? So valuations alone, we've been through this before and we'll hammer this again here in a minute, but valuations are a terrible short-term timing tool.
Yep, they sure are. They sure are.
Right.
Yeah.
Right? It's way more about earnings and earnings growth that it should be. So really, and there always seems to be maybe some sectors that, yes, they are overvalued,
Mhm.
right?
Yeah.
And then there's always some that are not. So really, if anything, this is just a case for diversification.
Yeah. Absolutely.
Yep. And to kind of go to that point again, so trying to use valuations as a timing tool, absolutely terrible. Really, what this is showing is basically the one year returns
Mhm.
of where various companies were valued and where they were a year later,
Yeah.
right? And absolutely all over the place.
Mhm.
There's no rhyme or reason to any data on this graph.
Yeah, on a 1 year. Yeah, who knows
Yeah.
exactly? Obviously, again, you listen to the talking heads, you get on CNBC or Fox Business or Bloomberg, any of the yeah, again, they're paid to have an opinion, but they don't know,
Yeah.
but they can't say that. I mean, right? I mean, they'd be out of a job really
They
quick,
can't
right?
tell you we
If they
don't
said we
know.
don't know, right? Yeah. So yeah, even some companies, they may not be profitable. So to kind of qualify, I remember about 20 years ago, I remember having a conversation with a client about Amazon stock, and this is not a stock recommendation, but he was saying, how could Amazon, blah blah blah, because they haven't even been
Mhm.
profitable for 5 years and so forth. This was kind of more at the
Yeah.
beginning of Amazon, right? But they were choosing to not be profitable because they were pumping all the money back into the company that we all use on almost a daily basis today. But they were pumping all that money into to building the company, and so it was a choice. Eventually, now they're profitable, right? They are kicking out actual earnings. And
Absolutely.
dividends and so forth. But yeah, it's one thing to say, hey, a .com maybe that has it's brand new. There legitimately are no earnings. Some of these companies actually have earnings, but at certain time periods, they may be just choosing to make investments.
Oh, yeah, absolutely. So, if anything is true about 2025 and carrying into 2026 is uncertainty just kind of reaching super high levels,
Yeah, sure
right?
have.
There's nothing's happening in the world, whether it's financial or not, that just plow into this uncertainty level. And so, it's uncomfortable,
Yeah,
right?
it
Very
is.
uncomfortable.
Again, planning in the midst of uncertainty, which again, it's kind of like a football game, anything like that, right? Does the head coach is paid to make decisions, and of course, yeah, they had a game plan going in on Sunday, right? The Broncos and the
Right?
Patriots, they had a game plan going into it, but did they have to adapt it a bunch of times? Of course, right? Because they didn't know exactly how it was going to play out. So yeah, just getting uncomfortable or just knowing that that's part of the ride is important.
Yeah, absolutely. So, and then of course, again, kind of on that same trend of valuations, like we were saying. So, yeah, are there places that are kind of overvalued right now? Well, yeah, the big easy one is tech sector, right? Largely because of how much infrastructure, payments building out of AI
Mhm.
that's going on there. So there's a
Yeah.
lot of money flowing around there. But that also means that there's, opportunities in other areas
Yeah,
as well.
other sectors, other countries, it may not even be US investments as well. So
Mhm.
big benefit of being diversified.
Absolutely. And the nice thing about it is it is across the very broad market,
Yeah.
right? So when we look at, say, the weighted S&P, so more weight on the bigger companies that are in there, obviously that's one indication. But if we did an equal weighted S&P 500,
Mhm.
gives us a pretty good indication of, okay, where is the value out there and how's it stacking up?
Yeah, I mean the standard S&P 500, about a third of it right now, is concentrated in a handful of companies. So that would be an argument against. Sometimes there's advice out there. Well, just buy the S&P 500. You might want to think about that. That might not actually have you as diversified as you think because of that concentration.
Mhm. So then, of course, bonds. We always look at bonds, of course, and so with yields, kind of, the Fed policy and what they're doing. So as things drop, obviously, shorter term rates drop faster than longer term rates. Intermediates tend to take a while to catch up,
They
right?
do.
For some reason.
Yeah,
So,
the Fed doesn't control long-term rates, so yeah,
yep.
it's really just the short-term rates that you'll see the immediate reaction.
Absolutely.
Mhm.
And it was probably what, 2 years ago now? We were talking about yield curves.
Mhm.
Everybody likes to jump on the yield curve thing and pretend that they're really smart and they know what it
Right,
means.
predicting
But
a recession, right?
right, predicting a recession. And I think the last three times in modern history that I can remember that
Mhm.
someone was talking about an inverted yield curve leading to a recession, and one did not show up,
Yeah.
right?
Yeah. It's kind of like saying, well, the stock market's always down in October. No, it's
Yeah,
not. It's not actually.
not a lot. Yeah,
Yeah.
absolutely. But really what we're trying to get at here is, yes, that yield curve has kind of flattened out,
Mm.
right? So no longer what we would call inverted, but not typical either of bonds. But there's definitely been times as well. So again, if we go back to 2022, that was just a rough year in the market
Yeah.
across the board.
Sure
So
was.
interest rates were rising up really, really fast. It means bonds did not diversify you out as much.
Mm.
Pretty much anything and everything that could go down was going down, right?
Yeah, kind of a standard 60-40 allocation didn't save you that year. In other
No,
words, yeah.
absolutely. And so really, it's that matter of our bonds kind of getting into that more normalized area, which I think they are heading that direction, right? So yes, they still can be a good diversifier, but also there are other things that can be good diversifiers out there as
Yeah,
well.
for sure. Like somebody mentioned gold before. Should you have some gold in your portfolio? Maybe,
Yep.
right? I say maybe just because we don't know. We need to talk to you as an investor, right? And what are you expecting,
Mhm.
right, out of your portfolio? But can it be part of a diversified portfolio? Absolutely.
Absolutely. And then of course, there's always someone saying, hey, what if this year repeats or that year repeats? So again, we kind of mentioned this earlier. 2022, 2022 started out with not, bonds not looking good before 2022 had
Yeah,
started,
yeah,
right? And so when 2020 hit, obviously there was a bit of a free fall in just about everything. Um, Typically what we see in the statistics is that if yields are higher coming into a year like that, there's not as much drop.
right.
So the likelihood of a 2022 hitting in the bond market again is highly unlikely.
Yeah, yeah, and again, a lot of it comes back to inflation too, and kind of what the Fed's thinking. And inflation is actually close to historical averages right now. We haven't talked about
Mhm.
that as much today, but that was really the issue back in 2022 was very high inflation, and the Fed
Absolutely.
having to react to that. Right now, inflation is at more of a normal level, which is about 3% a year historically over the last 100 years. Now, I know people might say, eggs or whatever, right, or whatever the item is, like insurance. I mean, that one was mentioned before. Are there some things that have gotten way more expensive? Absolutely. So
Yeah.
inflation is somewhat individual based off of kind of your own situation, right? And kind of where you're spending your money.
Yeah, absolutely. And then of course, where's the most value inside of there? So lots of different bonds, things that you can buy into, but relatively right now, kind of what we're seeing, cheaper ones. So your mortgage-backed securities, the general aggregate index, right,
Right.
of bonds in America, municipal bonds, etc.
Yeah. So bonds being part of a portfolio, not the most exciting part of a portfolio, but oftentimes that's not why we put bonds in. It's usually to make things less exciting,
Absolutely.
right? Less volatile.
Only need so much excitement in your portfolio,
Yeah,
right?
exactly.
Yeah. And then of course, the reason for diversification, right? So this is, of course, we always love these charts. This is called a Callan chart. Many different versions of these out there. But really all it shows is, what were each of these asset classes doing in these years? And you can tell it's all over the place, right? From year to year, it is all over the place. So that's why we spend so much time with clients on that diversification and risk tolerance
Mm.
conversation, right? Is how much volatility are you comfortable with? And then how do we stay diversified within that range?
Yeah, yeah, that's actually a surefire way to make your portfolio more volatile is if you just put everything in one area, because you'll have really good years and then you'll have horrible years, right? And you'll see
Mhm.
this kind of seesaw effect versus if you build out a diversified portfolio that covers a lot of different sectors. And on the chart, actually, it doesn't even show all of them, right? It doesn't really show alternative
Yeah,
investments,
not at all.
cryptocurrency, private equity, private real estate, other types of investments, and not saying that any of those are necessarily right for you. But there are lots of different asset classes, and so this is some art and some science, right? It's about trying to build a portfolio that has some zigging and zagging effect to it, right? So we're not completely in one area.
So overall, bottom line, expecting policy support, obviously AI investment, we're gonna keep an eye on as we cruise through it. All the signs pointing towards economic expansion continuing on, again, looking at international exposure, tech leadership, really those valuations. But overall, kind of staying diversified, using what is available out there and kind of keeping on the trend of doing what we do.
We do. Yep, absolutely. And we want you to make as much money as possible too, right? If we're managing your portfolio for any given risk level, a lot of people are surprised that international holdings were some of their best performers last year. Some people think, well, it was just because of the AI. Not necessarily, right? It could be some of those other areas, or if you had gold or other types of asset classes, those might have given you a much higher return than those typical AI type holdings. So do we think that you should have those areas covered? Absolutely, right? I mean, a diversified portfolio should do that, right? But that's not the only area right now. Lots of opportunities.
Yeah, and always keep in mind that those pullbacks and setbacks happen all the time. Just
Yeah.
kind of going back to that
Expect
first
it.
visual, right? Is just expect it.
Yeah.
It's not going to be a smooth ride, and it's never a straight line.
Now, me imagine it, and you can see our smiling team here on the screen. We're here for you, obviously, especially during tough times. And sometimes those tough times
Absolutely.
have nothing to do with the economy or the market, right? It could be something going on in your life. You might have lost a loved one, or you might be having problems with your kids or something like that. You might say, well, that's for a counselor. But a lot of times, though, money is related to it, right? Because, your money and your life are closely related, right? As far as the resources that you've got, the choices that you've got. So certainly those things need to be taken into account. That's why we really enjoy the financial planning process, because we get to know our clients so well. That's the best part about our job, right? Is relationships. And so we appreciate you. We thank you certainly for those of you who are clients. Thank you for those of you who are about to be clients. Thank you as well, right? I think we're somewhat unique in that, not just do we care about our clients, but the care and attention that we put into what we do is pretty high.
Absolutely. Oh, we had a good question here.
Ah.
They want some names. Yes. So we'll go from left to right, I guess. Right. So up in the top right, left corner, Sherry Sturgis. And then there's myself and Josh, and then Sarah Nelson up there in the right. Right in the middle on the left-hand side, that is Robin Tomlinson. She is one of our newer hires, it feels like, although she's probably been here longer than I can imagine.
Yeah, almost a year.
Almost a year. Okay.
Yeah, a lot of industry experience though.
Yeah.
16, 17 years at Edward
Yeah,
Jones before. Yeah.
Yep. And then our two newest advisors. So most of you have probably already met Jen. They're right in the middle. And then Michael is our newest one. So I think a nice thing went out in the Keystonian today, giving
Yeah.
us kind of an intro to Michael. And then, of course, we have Lynn on the middle right there. And then across the bottom, we have Marcy Sadler. Again, if you've been with us for a while, chances are you've probably heard from Marcy or talked to her. And then Amanda, she's up at our front desk. So you probably, if you've called into the office, you probably talked to her, right? And then Wendy down there in the bottom right. So that makes up our current Keystone team.
Yep.
So
That is our greatest strength.
that it is.
For sure. Is the people element to this is huge. And we don't ever want to discount that. It's people on the team, obviously the people that we choose to work with as clients. Too, I can say that we really enjoy the people we work with as well. It's a high trust relationship, right? We're doing something, there's substance there, but ultimately it ends up being a pretty tight relationship. So that's fun.
Absolutely. And then of course, our contact information. So if you are watching this after the fact, Josh at keystonefinancial.com, Jeremy at keystonefinancial.com. We love those questions. Happy to take them. This one, you'll also see a cute little QR code up there in the top right corner of this slide. That actually takes you to a calendar of ours. We have a special calendar. It's attached to all four of the advisors here. It's called an Ask Me Anything call. It's really a chance to set up a 20-minute call if maybe you're not a client, you just want to learn more about us or have some specific questions. We're always happy to take those phone calls and at least get you pointed in the right direction if we can.
Yeah, on our website, it's a great resource as well. It's keystonefinancial.com, as you can imagine, right, for our email addresses. Our main office location's in Loveland, Colorado. We actually work with clients all over the country. It's about 80-20 now. 80% of our clients live within driving distance of our office. The other 20% live every place else, right? So
Yeah.
yeah, literally, I don't know how many states we are at this point, but kind of spread across the whole country. Sometimes because that's where you've always lived, sometimes because you moved for retirement or be close to kids or a job or something like that. So we're very comfortable working both ways, both in the office, but also remotely via Zoom.
Absolutely.
Any other
So,
questions?
you
We got a
know,
couple more minutes.
we do have a couple more minutes, so last chance to get those questions in there. I believe we answered everything that did get listed on that. Um, But of course, you can always use those emails or that phone number if you want to get a hold of us here. And we can take your questions at that time as well.
Give people a few more seconds here, but yeah, it's the one thing that we always are hyper vigilant on is making sure that we've got enough bandwidth, right? And that's why we have so many people on the team, so many advisors, is that that's the most common reason why people actually leave their financial advisor is because they say, well, I never hear from them, or I reach out to them and they don't call me back, they don't email me back. I know we laugh about it because it's like, what? I mean, that's how
Yeah,
stupid is that, right? I mean, that's free, right? There's a lot of things we can't control, right? We can't control the market and politics and all
absolutely.
that stuff, but we can control calling somebody back, right? But a lot of times what happens is that firms grow and grow and grow, and they don't add enough team to be able to support the clients, and so
True.
that's pretty important. We do put a lot of focus on that.
Absolutely.
Great.
All right. Well, we are coming up to our 60-minute window, and I
Yeah.
don't see any more questions, Josh. So we must have just done a really good job of
We
explaining.
did. Yeah. And again, we're accessible. So anything that you think of, especially if you want to talk about it individually, sometimes in a more public format, that may not be something you want to ask. You use one of those resources that we talked about before. So
Absolutely.
with that, yeah, thank you. Thank you for your time today. Certainly thank you for listening. For those of you who are on the podcast, we appreciate you and hope you have a wonderful day.
Absolutely. Take care.